and we will pass it over to Ron Nipping. Ron, take it away.
Thanks, Sam. On behalf of Raymond, thank you for taking time out of your busy schedules as we go over the CARES Act and how it could potentially apply to you. Raymond has diligently been working through all the complexities of this act and are continuously preparing to help clients navigate what's next. This act was signed on Friday, March 27th. I don't know about you, but it feels like forever ago and it feels like yesterday. The whole act is designed to attempt, and I think it will succeed in keeping Americans at work and getting paid if it executes correctly. Today, our speakers, first off, will be Tom Szymanski. He'll talk about business operations and how to work through with the CARE Act. I'll come in the middle with telling you potential ways that the CARE Act can get money to American businesses to keep Americans working. And Tony will be talking about aspects of the tax impact of the CARES Act, which will also hopefully get money to you faster and keep your businesses running. Tom, I'll hand it over to you.
All right, thanks, Ron. I'm just going to run through some basic preparation plans that I'm sure most of you are well underway of. But it's really important as you start to evaluate the options that are available in the CARES Act that you have a good understanding about where your business is at today, and also focus on just preparing the information so you'll be able to maximize what you can use on the CARE Act. A couple things that I wanted to run through. First is, a lot of businesses are faced with, the question of, how do I support some of my essential customers, that only represents 5 or 10 or 15% of my traditional volume. And, obviously I want to do my part to help, but, this is putting a tremendous amount of stress, on my business. And obviously the first step is, really just figuring out what staffing levels you need to execute a low volume plan, scaling your operations to fit, that level of support. And then the other thing is really, talk to your customers, especially on the small business front. A lot of small businesses are in this position where their suppliers and their customers are both larger companies than you are. So reach out to those folks and see, on the customer side, are they willing to pay in advance on materials or put a deposit, or are there premium options to help get things done as fast as possible, and see what your key stakeholders really can do to help in the process. The next thing is, what if your business is really, looking at an extended period? You really don't have any non-essential customers. Your business really came to a screeching halt when the stay-at-home order came out, and really the 13-week cash flow is a tool, is a model that is really important to understand. Where am I today? What are my anticipated incoming cash flows over the next 13 weeks? What are my expenses? And just having a template to kind of move things around so you can manage that process and make some assumptions, so you can really understand where you're at today and what you need to do to get through the next time period. Focus on your collections. Everyone, is going to want to slow up payments, and so it's important that you express how critical it is, for payments to come in to keep your business liquid, and so stay on the phone lines and really make sure that you close out those open receivables and get those payments in, and then really just understand your payroll assumption, your payroll, and that's really where you need to evaluate all the various options that are out there, and understand how you're going to plan your payroll over this next 13-week time frame, utilizing maybe some of these tools to get your plan in place. And you really, a lot of these things all start with communication. If you have shareholders, your bank in particular, key customer suppliers, these are all folks that you need to have good open communications with, particularly with your shareholders and with your lenders. For example, there's a lot of banks that are offering payment deferrals. the new payroll protection acts will be flowing through the bank. So it's really important that you're communicating with your lender, what impacts are happening in your business, what tools or payment deferrals are available, what loans are available to help, and just keep those communication lines consistently open. Payment deferrals, like I said, a lot of banks have already come out with term and mortgage type deferrals. Also, don't be afraid to approach your landlord. There's a lot of landlords that are showing some flexibility with rent payments and understanding that, and it's because they're going to their mortgage companies and they're getting deferrals. So there is some ability out there and willingness to help spread some of these fixed costs out as we work through this stay-at-home order. With that, I'm going to switch this over to back to Ron, so he can kind of walk through what some of the specific CARE Act small business loans are available.
Hey, thanks, Tom. Now I'll provide a high-level answer to the most common question we're getting on the payroll protection program: where's my money? $350 billion is how much Congress has put aside in the CARES Act, focused on American small and medium-sized businesses staying open and keeping their employees at work. Now, the loan provisions under the CARES Act are designed to keep small and medium-sized businesses and their employees at work. The most common refrain we hear after we go over the program details with our clients is, "It sounds too good to be true." Actually, it's an incredibly well-designed program that is focused on getting American small and medium-sized businesses through the critical and crucial next few months. The major challenge for the operation of this act will most likely fall on the shoulders of our banks. They're tasked with executing. Now, for covering fixed expenses and for federal and state programs, we encourage our clients to explore them all. Currently, the MEDC has a Michigan Business Relief Program out with grants for up to $10,000 and potential loans of $25,000 and above. Also, many localities in Michigan are focused on some local grants from the local economic development organizations, and the same goes for Ohio and Florida. Most of our clients are focusing on the payroll protection program first, then potentially exploring the Small Business Association economic injury disaster loans later if needed. The key thing on the competition or considering each of those programs is if you apply for both, you cannot use payroll needs and the other costs covered under the PPP to apply for the economic injury disaster loans. That would be double dipping. Now, no laughing on this next slide, please. Now we'll look at the payroll protection program. So how much can I borrow as a business owner? The amount you can borrow is based on your average monthly payroll costs over the last 12 months. And basically, in a nutshell, you can borrow 2.5 times your average monthly payroll costs over the past 12 months, up to $10 million. Now, there's two slight twists in this. One is if your business was in business as of January 1, 2019. And then secondly, if your business started up last year. So generally, you get to borrow 2.5 times your average monthly payroll of the last 12 months. Now, who's eligible to obtain a loan? There's a lot of words on this slide, but basically, during the covered period, loan eligibility includes small businesses and other organizations based on employee size requirement. Eligible business would include any business, 501c3 nonprofit organization, 501c19 veterans organizations, or tribal businesses with 500 employees or fewer. Now, the next or is important, or if applicable, the Small Business Association size standards for its industry, whichever is greater. Typically, when you're working with the SBA, it's whichever is smaller or both. There are industries out there that are considered small, even if they have up to 1,500, 1,700 employees. So that's something to look at. Another caveat in there is the business in accommodation and food service. When you have an NAICS code starts with 72. Key there is you have 500 or fewer employees per physical location. Now, sole proprietors, independent contractors, and eligible self-employed individuals are also included in this. Now, here's the good news, first part of good news of this. ACT's 4% interest rate payments over a 10-year period for the portion of the loan that may not be eligible for forgiveness. Now, for payroll, to eligible employees include those on full-time, part-time, and other basis. The other basis is your 1099 independent contractors. Now, how can the loans be used? Since the program is specifically designed to help keep employees at work, proceeds from these loans may only be used for certain purposes. Permitted uses include payroll costs as defined in the Act, costs related to the continuation of healthcare benefits during periods of paid sick, medical, or family leave and insurance proceeds, employee salaries, commissions, similar compensation, interest payments on any mortgage obligation. Now, you can't use it for prepaying the principal payments or the principal payments on your mortgage. Rent, including rent under a lease agreement, your utilities, and interest on any other debt obligations incurred before the covered period, which for the purposes of the Act is February 15th of this year. Now, what's key here is make sure you keep records of all these expenditures, because that's what your forgiveness is going to be based on. Now, when you go to devil's in the detail, the payroll costs, what does that mean? It is the employee compensation, salary, wages, commissions, cash, tips. It's payment for vacation, parental, family, medical, or sick leave, allowance for dismissal or separation, payment for group health benefits, including premiums, payment of retirement benefits. That's what the company is putting in for matches and profit sharing, state and local payroll taxes, and the sum of any compensation to those previously mentioned sole proprietors or independent contractors, not to exceed $100,000 in 1 year. Payroll costs, things it wouldn't include. It does not include individual employee compensation above $100,000 per year, prorated for the covered period. That's per month for the months. Now, that doesn't say if someone makes $105,000, that whole compensation is not included in the calculations. It's only the dollars over $100,000 that are removed from the calculation. Now, if you have people working overseas, they're not included, or those that are being covered by the Families First Coronavirus Response Act.
Ron, I have a question here. Someone has asked, does workers' comp count as a payroll expense?
Let me dig that out for you while we're talking.
Great. And for anybody who's asking questions, we've got a lot of questions coming in, so we'll attempt to answer those on the call. We might wait just a little bit just to see if your questions are answered as part of the presentation. And some of the panelists may answer your questions individually using the chat box on the side as well.
So the question is on when do I get to repay this? Do I have to start making payments on this loan right away? The answer is probably not. For the most part, at least 6 months later, potentially up to a year, is when your payments on the loan that's not forgiven will take place. I'm sorry for the delay in switching pages. My mouse is not working, so I'm using my touchpad.
Tom, if you need any help with that, you just say next slide, and I'll be happy to kick in and help you with that.
Okay. All right. I missed one. Yeah, there we go. So when I say loan forgiveness, that catches people's ears because that means some of this loan may actually end up not having to be repaid and ends up being free money from the government. So would these loans be eligible for forgiveness? Yes, but not all of it automatically. The amount of the loan eligible for forgiveness would be equal to the sum of the payments for specific expenses, which we touched upon earlier. These would be your payments towards mortgage interest, towards covered rent, towards covered payroll costs, and covered utility expenses. Note that the amount forgiven won't be more than the amount of the loan. Just wanted to throw that one in there. Now, on this forgiven loan, there are two ways that it could be reduced, and that comes around with what the intent of the loan is keeping Americans working and keeping them getting paid. So if the borrower, yourselves, cut back on the number of staff or the amount they're being paid, the loan will still be eligible for forgiveness, but it would potentially, forgiveness amount would be removed. And basically how many employees you have working for you at the end of the covered period, which would be not later than June 30th, that percentage that you have less than you did last year, basically, that percent would be the factor to reduce the loan forgiveness. And the same with the compensation. If the compensation is the compensation reduction is more than 25%. Then the question comes in, what if the borrower rehires its employees and raises salaries once things improve? Well, if you get that done by the end of the covered period, some of the forgiveness reduction will be removed. So there's ways to work that through, and again, work with your Raymond business advisor to get those calculations done. Now, how would a borrower apply for these PPP loans? Remember what I said about the banks having the hardest role here. They're building the processes to apply for these loans literally as we speak. Most banks are planning to take applications via their websites, and we've heard many will only be working with their clients who have had an account with them since February 15th of this year. So reach out to your banker, tell them that you're interested in applying for the PPP, and make sure they know that you want it. If you don't have a banking relationship, again, please reach out to your Raymond advisor. Perhaps we can make an introduction or two. So as we talked about earlier, the loan is based on your average monthly payroll costs over the last 12 months. So if you're looking to apply for one of the PPP loans, start now gathering your documentation for your payroll costs. Now, this is the information we believe will most likely be required by the banks, but again, they'll all have their own processes. So if you would gather your 2019 IRS quarterlies 940, 941, or 944 payroll tax reports, your last 12 months of payroll reports, beginning with your last payroll date and going backwards up to January 1st, 2019, if you have those records. And the payroll report needs to show the following for the time period above: the gross wages for each employee, including the officers if paid W-2 wages, paid time off for each employee, vacation pay for each employee, family medical leave pay for each employee, and the state and local taxes assessed on the employee's compensation for each employee. You'd also want the 1099s for 2019 for independent contractors that would otherwise be an employee of your business. documentation showing total of all health insurance premiums paid by the company owner under a group health plan and include all employees and the company owners. Now, you'd also want to document the sum of retirement plan funding that was paid by the company owner, and do not include funding that came from the employees out of their paycheck deferrals, and include all employees, including the company owners. That would be for your 401k plan, simple, SEP, whatever. And again, can't be said too much. Make sure you reach out to your banker and let them know you're applying. Now, Tony's going to be talking about the tax provisions next.
All right, thank you, Ron. So whenever we have a stimulus package, one of the first areas the government is going to go to or look at is going to be the tax code. And whether that be through payroll tax credits or income tax changes, and we're going to cover several of these items included in the CARES Act. But before we do get to that, I want to first discuss the deadline and payment postponement. As I'm sure most people are aware, the due date for filing federal income tax returns and making federal income tax payments was postponed until July 15th. So Treasury initially said you would have to still file or extend by April 15th, but within a few days, the additional guidance came out postponing both the filing and the payment due date. Also, there are no limitations on how much you can defer or postpone. Again, Treasury initially said there would be a limit deferral up to $1 million for individuals and $10 million for corporations, but they did back away from that and took a really simple approach, meaning everyone's automatically, as long as it's a April 15th due date or payment due date, everyone's automatically postponed until July 15th, regardless of amount, so we don't have to worry about limitation calculations. Also on there, payments generally include both 2019 return payments as well as 2020 first quarter estimates. So as of now, second quarter estimates are still due on June 15th. So they're actually due before first quarter estimates, but again, that could change down the road. So so everything I just covered was on the federal side, but what about the state? So most states have come out with guidance. So for example, Michigan, the state where I am located, has extended until July 15th for both the individual and their corporate returns. But not all states have come out with guidance, and not all are extended to July 15th. So that is something that we are tracking closely to make sure nothing gets missed down the road. So with that, we're going to move over to the CARES Act provisions, and we're going to start off first by covering a couple of the individual tax provisions that were included in the bill. So let's start off with the recovery rebate, and this is one of the provisions in the CARES Act that is receiving the most attention in the news and the media. So how does it actually work, though? Well, it is a tax credit that you essentially receive in advance from the government by them depositing money into your account if you have a direct deposit set up with your tax return, or by them actually sending you a physical check in the mail. And the credit is up to $1,200 for single individuals or $2,400 for married couples filing a joint return. Additionally, you can get a $500 credit per qualifying child, and that's generally going to be any child that's under the age of 17 is going to qualify, similar to the child tax credit as well. Now, the credit is subject to income phase-outs based on a taxpayer's adjusted gross income for the year. So for a single individual, once you get to $75,000 of adjusted gross income, that amount is going to start to phase out, and by the time you get to $99,000, you will be completely phased out from the credit. For married filing joint, it's going to start to phase out at $150,000 of AGI, and then by the time you get to $198,000, you're going to be completely phased out. So it's not a cliff, meaning that once you get to X amount of income, you are completely disallowed the credit. it's going to phase out over that period. So what's the IRS actually going to do to determine the amount that they're going to send you? Because they're not just going to send you $1,200 or $24. They're going to look at your most recently filed tax return, because again, this is a 2020 tax credit, and we obviously haven't filed any 2020 tax returns yet. So again, they're going to look back and they're going to say, did you file a 2019 return? If so, I'm going to look at that, meaning the IRS is going to look at that. If not, we're going to look back to your 2018 tax return to determine whether or not you qualify and how much we're actually going to send you. And one other thing to point out on this provision, who's actually eligible for it? So what is an eligible individual? And this is going to be any non-resident alien, who is not qualified is going to be any non-resident alien, and then any individual for whom a dependency deduction is allowable to another taxpayer. And the key there is the word allowable. So that means if you have a child who can be claimed as dependent by their parents, they're not going to be eligible for this credit just because you chose not to claim them. The word there is allowable. So once they can be claimed, you automatically are disqualified for that dependent receiving that credit. So that is the rebate credit. They estimate this is going to cost about $300 billion, and they estimate 90% of individuals and taxpayers will be able to benefit from this. So they're not going to be in the completely phased out threshold. So moving down the list, the next thing on there is the student loans paid by employers. So employers can now pay up to about $5,000 or a little over $5,000 of an employee's student loan. And this amount does not have to be included in the employee's W-2 income. So similar provisions for paying employee education expenses have been around for some time. They just never actually covered or were applied to the direct payment of student loans on the employee's behalf. So moving on to the next slide, we're going to get into some of the retirement plan provisions. You can now withdraw up to $100,000 from a qualified retirement plan without being subject to that 10% early withdrawal penalty. And this is for withdrawals that take place during 2020. So the distribution has to be related to financial hardships as a result of COVID-19. And the bill itself does get into more detail on these situations, but they take a pretty broad approach, so it's pretty taxpayer favorable. Also, the taxpayer does have the option to spread the income inclusion from the withdrawal out over the next 3 years on their tax return. So you don't have to pay the tax on it all in 1 year. You can elect to do so if for some reason you think you can afford to and you're going to be in a lower tax bracket. You can elect to do so in 1 year, but you do not have to. Also, you can recontribute those amounts. So you make a withdrawal, you can actually recontribute those amounts back to your retirement plan over a 3-year period without having to worry about annual contribution limitations. So option 1 is withdrawal. Option 2, you can take out a loan up to $100,000, and there are some flexibility with repayment terms there. So obviously, taking money from your retirement plan is one of those last resort options. But if you do, or you are considering it, I would definitely reach out to your Raymond advisor to help really determine what the best approach for you would be. Also, last item on there, there is a temporary waiver of required minimum distributions for 2020 as well. So a couple smaller provisions that are included in here. Charitable contributions. So anyone who does not itemize deductions on their 1040 will be allowed for 2020 an above the line deduction for up to $300 of charitable contributions. So if you take the standard deduction, you can still receive a very small benefit for your contributions in 2020. At the same time, anyone who does itemize deductions, the income-based limitations are temporarily lifted for 2020. So, for example, for cash donations, you are limited to 60% of your income as far as how much you can deduct that year. So they are essentially they're encouraging people to donate by making it as easy as possible to receive the tax benefit during the actual year of your donation. So that was some of the individual provisions. Now let's move on to the actual business provisions that were included in here. And the first one on there is yet another separate payroll tax credit, and this is the employee retention credit. So this is a refundable payroll tax credit. It is up to 50% of qualified wages paid by an eligible employer to an employee. So we have a couple of terms defined there. Number one, what is an eligible employer? So the only thing you have to have, there's a couple of situations, but number one is you have to have operations that were impacted by a COVID-19 government order, for instance, some type of shelter-in-place order. Or if you don't have that, you just have to have a greater than 50% reduction in quarterly sales measured on a year-over-year basis. And there are some restrictions on when you can utilize this credit. For example, and we'll get into more, if you do utilize one of the small business interruption loans that Ron covered, you would not be able to utilize this as well. And the theme is going to basically be that they don't want you benefiting or double dipping from any of these credits. They want you to be able to utilize one or the other, but not both at the same time for the same amount of wages. So eligible employers, we just defined. What about what wages are actually going to qualify? And there's a couple set of rules here depending on employer size or the amount of employees that you have. So if you have 100 or fewer employees, it's very simple. All wages are going to qualify for the credit. But if you are over 100 employees, only the wages of the employees who are furloughed or faced, if they face some type of reduced hours, only those wages are going to qualify. And there is a cap. Qualified wages can't exceed $10,000 per employee, which means if the credit is based off of 50% of eligible wages and you can't exceed $10,000 per employee, that's basically a cap of $5,000 per employee, assuming they get up to that $10,000 of eligible wages. So one of the bigger questions is how are all these credits going to work together with each other? And it's not entirely clear, but the bill does spell out certain restrictions. So number one, for the employee retention credit, wages that you include under the Families First Act, so that's going to be the mandated sick and child care leave provisions, wages that you do include under there are not going to be eligible wages for the employee retention credit. And again, they don't want people double dipping and benefiting from the same amount of wages in both areas. Number two, wages are not eligible if you take a credit for paid family and medical leave under Section 45S. And this is not the credit under the Families First Act. This was actually created back in December of 2017 when they passed the Tax Cuts and Jobs Act. And that was actually extended in December of 2019 for another year. And this credit is generally going to be much less favorable, but the key here is it does apply to employers with over 500 employees. So if you are a large employer, it's definitely worth reviewing some of these credits to see if you can benefit, and then more importantly, how you can actually optimize them. Another one of the conditions is if you do take a work opportunity tax credit for a certain employee, and these are targeted groups that are eligible for the work opportunity tax credit. If you do take one on that employee, their wages are not going to be eligible as well. So a lot going on with the credits, the loans, and how all these things are going to interact with each other. Again, it's not completely clear, but we do know, to summarize a couple things, again, we have the employee retention credit, which is a payroll tax credit, which is from the CARES Act, that is limited to $10,000 of, or 50% of $10,000 of qualifying wages. We then have the Family's First payroll tax credits, which are for the new mandated sick and child care leave provisions. And then we also have the Section 45S paid family and medical leave credit, which is it's not a payroll tax credit, it is a general business credit, meaning you claim it when you file your return. And this credit is a couple of years old. It's from the Tax Cuts and Jobs Act passed back in 2017, and it was first applicable for 2018, I believe. So sticking with payroll taxes, there is a FICA tax deferral for employers. So this allows employers to defer paying the employer portion of certain payroll taxes through the end of 2020. And it's a deferral, so you have to repay that amount, and you repay it, 50% would come due on December 31st, 2021, and then the remaining 50% would come due December 31st, 2022. Now, just like everything else, there are going to be limitations on when you can use this. So, for example, if you utilize an SBA loan with a forgiveness piece or portion like the one that Ron just covered, you cannot also defer paying your payroll taxes. So again, theme's going to be here is figuring out how all these provisions are going to be intertwined and intermixed and how they're all going to work together. Also, self-employed individuals, there is also some provisions for them to allow them to defer their federal self-employment taxes on their actual filing of their tax return. So that was basically some new stuff. Now we're going to talk about some items that were changed or altered, and most of them are related to, again, that Tax Cuts and Jobs Act that was passed back in December of 2017. So the first item on there is the modification of rules relating to net operating losses, or NOLs. And you can now carry back NOLs for up to 5 years. So again, the Tax Cuts and Jobs Act eliminated the carryback of NOLs, but they are back, not only for 2020, but also for 2018 and 2019 as well. So this provision is retroactive. And that means there are going to be certain opportunities, in some cases, to amend or file carryback forms for these prior year returns that had NOLs on them to be able to actually utilize these NOLs. And in addition to being able to carry them back, the 80% taxable income limitation is suspended until 2021. So this is going to allow businesses to fully offset taxable income in specific years. Now, somewhat related to this, the excess business loss limitation. This is for non-corporate taxpayers, so you see it a lot on the 1040 where you have losses. This is basically a fourth level of loss limitation that's applied at the 1040 level. You have things like passive loss limitations, at-risk limitations, and other basis limitations and stuff like that. This was a fourth level that was instituted as part of the Tax Cuts and Jobs Act. Well, this has been suspended, and again, it was applied retroactively. So going back to 2018 when it first came into play, all the way through 2020. So again, just want to point out, because these rules are effective for 2018 and 2019, there are going to be some opportunities to generate, cash refund relatively quickly for your business or for you personally if you incurred losses in those years. Now, the catch-22 there is 2018 and 2019 for the most part. There was a slowdown, but for the most part, those tended to be very good years for the economy. So many businesses are going to have to wait until 2020. That's going to be the first year they're actually going to be able to utilize some of these loss carry forward rules because they made profits in 2018 and 2019. All right, so that summed up the NOLs. We're going to skip over the corporate credit for prior year minimum tax. Just know that that's been accelerated. If you are a C corporation and you do have AMT prior year credits, it's going to be accelerated. So business interest limitation modifications, or the business interest expense limitation. Now, this was another Tax Cuts and Jobs Act provision that came into effect in 2018. It essentially limited the amount of business interest expense, and that's key, it's business interest expense that a taxpayer can deduct. So it doesn't include things like investment interest, And it doesn't include things like mortgage interest because those have their own set of limitations as well. So the percentage was raised from 30% to 50% of adjusted taxable income. Now, adjusted taxable income, just generally think of this as a almost modified EBITDA calculation, but instead you are using taxable income instead of your book or your financial statement income. On top of the increased limitation, you are also going to be able to, for 2020, use your 2019 adjusted taxable income to determine the amount of the limitation. And the reason being here is 2019 is most likely going to be a much better year, meaning your adjusted taxable income is going to be much higher, meaning you're going to be able to deduct more business interest expense, if not all the business interest expense, because you are showing a higher adjusted taxable income number. So that's business interest expense changes. Moving down the list, technical corrections for qualified improvement property. So again, some background here. When the Tax Cuts and Jobs Act was passed, there was a mistake made in the wording on one of the provisions that turned qualified improvement property, and we'll talk a little bit about what is qualified improvement property. It turned it into 39-year property, which made it no longer eligible for bonus depreciation. It used to be 15-year property, and that was the intent, but on the wording and the provisions, they screwed that up and made it 39-year property. And this was, commonly known as the retail glitch, because it does affect, not exclusively, but it definitely does affect retailers, restaurants, and industries like that. But it can definitely affect all types of businesses, including manufacturers as well. So what happened as a result of this? Well, instead of getting an immediate write-off, you had to depreciate that asset or those assets over 39 years, which obviously made that deduction a lot less valuable. So you go from 50% or 100%, because the pre-2017 or 2017 bonus depreciation for the most part was 50%. You go from 50% or 100% depreciation to a 39-year, basically 4-decade write-off over that period. So what the CARES Act has done is they've essentially fixed this issue, and the effective date is for property placed in service after December 31st, 2017. So again, it's one of those retroactive provisions, in this case because it is a technical correction. So again, we have another opportunity to amend 2018 and 2019 returns and then generate some type of cash refund as a result. So we can walk through an example. Let's define qualified improvement property first. And it's generally, there's always exceptions, but it's going to be generally internal improvements to a non-residential building. That's key. It can't be residential buildings. That are not going to be structural in nature. So they can't be, load-bearing walls and stuff like that. So let's use renovations as an example. And let's say we have let's use a restaurant group because that was specifically pointed out in Congress's or in the Senate Republicans' summary of the provisions. So restaurant groups obviously struggling now. So let's say we had a restaurant group that decided to remodel several locations back in 2018. And its costs, we'll use $1 million were the cost of the renovation. So back in 2018, that $1 million of renovations had to be capitalized and depreciated over a 39-year period. So that's about a $25,000 or so deduction each year that you get over the next 4 decades. With a new tax law change, we can now amend the 2018 returns and also the owner's returns as well, and take that $1 million deduction for that year. Again, this is assuming it's all qualified improvement property, which if we go with about a 30% tax rate, you can now get a refund or a benefit of up to $300,000, again, assuming $1 million on the federal side. So much, basically weighing the decision, do I want $300,000 now, or do I want to take a $25,000 deduction over the next 4 decades? So that's a pretty easy decision on what a taxpayer would want. But again, it's never going to be as simple as that example. Obviously, that's a no-brainer case there. But we do need to account for the cost of analyzing fixed assets to see what actually qualifies as qualified improvement property. Because again, it's not going to be if you construct a building or something, that's not going to be qualified improvement property. It is internal improvements. Also, you have to factor in the cost of amending the business return, as well as the owner's returns for potentially multiple years. So if you have a large group of owners, that's a significant amount of 1040 or individual tax returns that you are going to have to amend as a result. But we do think there are and there can be a lot of good opportunities here. Let's finish up that slide. So charitable contribution limitation, the old limitation for C corporations we're talking about now, that limitation was 10% of taxable income. It's now been bumped up to 25% to, again, encourage donations for the year. So a couple things I want to wrap up on. Number one is, it's not my slides, but since the SBA loans and the payroll protection loans do, as Ron was talking about, have an element and probably a significant element of forgiveness of debt involved with them. So generally with the tax code, anytime you have forgiveness of debt, now there are exceptions when it comes to residential, your home and stuff like that, but anytime you have forgiveness of debt, you have to include it in your income when you file your tax return. And this is not going to be the case for the forgiveness of debt that the loans that Ron was covering. They're generally not going to be taxable to an individual. So again, quite a few tax law changes that were included with the CARES Act. Obviously, we know from what we've been hearing and our clients that their number one priorities right now aren't tax laws. They are, taking care of employees and maintaining cash flow. And so those are the number one things. But we want to make sure everyone is aware of these provisions and that really that we're looking at every opportunity across all of our departments at Raymond to look for any potential for any cash flow increases at this time. And with that, I'm going to turn it back over.
Thank you, Tony, Ron, and Tom. We have a few minutes left for some Q&A. We did receive a lot of questions throughout the presentation, so we're going to go ahead and answer a few, and we will respond via email if we can't get to everything. I know we can't get to everything today, so we appreciate you sending all those in. If we could, I want to have Ron and Tom and Tony just make sure you are all unmuted, and we will kick off. So one of the first questions we have on our list here is, I see you can apply for the SBA loan directly on the SBA's website. Does the business have to go through a local bank, or can they apply directly using the website? What's the protocol?
I'll take that one, Sam, if you're all right with that.
Yeah, that's great.
The payroll protection program needs to be applied through your bank. As far as I know, unless it's changed the last 48 minutes or so, you are not able to apply for the payroll protection program directly through the SBA website. On the SBA website, there is the ability to directly apply for the economic injury disaster loans and the express SBA loans, but not for the PPP. The rationale for that is it currently takes over 3 to 3.5 weeks on average for the SBA to approve one of those economic injury disaster loans that is submitted through their website, and their website is often crashed because of the volume. The intent of the PPP is to get money out into the economy to pay people to be at work. That's why it's going through the banks. And the banks are working incredibly hard right now to get their processes in place. And the goal is to have it not later than April 6th. There are some rumblings it might even be available by this Friday. So stay in touch with your bank and gather the information we discussed and be ready to apply. I'd like to add on top of that what Tony was mentioning on the not taxable for the forgiveness of debt. It's also, this is a first step. Applying for the PPP is a first step. It's designed to be that bridge to get you through this tough part. But the 13-week cash flow that Tom was talking about, maybe you can expand a little bit more on, is incredibly important for the next 13 weeks because you have this money coming in. Yeah, you should have a plan for it. That's on your cash flow. And then if reality is different than plan, you need to have good communications with your Raymond business advisor to say, now what? What does this mean going forward? Because if I need more money, should I do the SBA loan? Should I go to the bank? Should I cut costs? And that's where Tom's group comes in, very important. Thanks, Sam.
Sure. So the next question, it looks like this one is for Tony. For the employee credit at multiple businesses, but none with over 100 employees. So which set of rules would I use in this scenario?
Yeah, so for the employee retention credit for almost everything that we're going to be talking about, there is a set of rules that applies that you basically have to look at to determine your control group. So if you have multiple businesses, and without getting into all the details of it, and let's say you're just 100% owner of these multiple businesses, you are going to have to aggregate your employees together to determine which set of rules you're going to apply. And in your case, if you're talking about the retention credit, again, you're going to have to look, you're going to have to use the rules that only apply to wages of employees who are basically furloughed or who face some type of reduced hours.
Okay, sounds good. Another question that we had come through, and this could be any of you, just let me know, says, my husband and I operate a small business. It is a fishing charter, and we receive self-employment income. Our income will be impacted by this crisis. How does the CARES Act apply to those who have self-employment income?
I'll kick in. This is Ron again. For the self-employed sole proprietor flow through, your income that you get should be you should be able to apply through your bank for the payroll protection program.
And Ron, I'll just add on to that. Most of the provisions that I just went over on the tax side do include some type of provision for self-employed individuals as well.
And then in addition to, so in the beginning of the presentation, Tom, you had actually mentioned the 13-week cash flow. Is this something that there are generally templates for? Is there like a way to start this process? How would we go about thinking through this more?
Yeah, we've got a standard 13-week template just to kind of outline, the basic process of trying to document your collections and expenditures. So yeah, we do have a template that we can share that will give someone a pretty good idea. And then if it needs to be customized, then that's something we can help clients with trying to get it customized to fit their particular business. But we do have a starting point.
Okay, thank you. This next one says, how do I get my payment if I do not use a direct deposit? So Tony, I think that one might be for you.
Yeah, so I think they're referring to the rebate credit. So there's a couple things there. Number one, they can just send you a check to your last known address. But also, they did release a couple of FAQs over the past couple of days. And apparently there is going to be some type of program or some type of system set up where you can actually go online and submit your bank information to the IRS so they can actually, even if you didn't use direct deposit on your tax return, they can actually still direct deposit the rebate credit there. The system, the last I checked, which was earlier this morning, is not up and running. I think they said it will be within a week, though.
Okay, thanks, Tony. And then actually this next one came in for you too. Was the $10,000 tax limitation removed, $10,000 tax limitation removed?
I'm assuming they are referring to the state and local $10,000 limitation that was part of the Tax Cuts and Jobs Act back in, well, it was first applicable back in 2018. And the short answer is no, this was not removed. It was definitely discussed. I know it was part or seriously discussed on the House Democratic side of being included in the provision, but no, that limitation for state and local deductions is still applicable going forward.
Okay, sounds good. And then this one came in too. It says, is married filing separate treated like single, or are there different provisions?
So I'm, again, assuming they're talking about the rebate credit, in which case you would just receive $1,200.
Okay. And do student loan payments count as payroll for purposes of PPP?
Yeah, so I'm not sure on that question. If you do make student loan payments, it is going to be deductible for the employer, as I would imagine compensation costs, but I don't know if they've actually linked on whether or not that would still be compensation eligible for the PPP.
Okay. Sounds good. Thank you. Just going through a few additional ones here. Do independent contractors count in the average monthly payroll cost calculation?
Yes.
Yep.
Up to $100,000 per independent contractor on an annual basis.
Okay. That makes sense. And you know what? I think a lot of these we are planning to follow up with via email. They are very specific. So just as a reminder to make sure we are always looping in our business advisors. As we mentioned during the presentation today, the team is really rallying around the CARES Act and all of the navigation with everything with COVID-related issues. So we thank you, everyone, for your time today. We really appreciate you joining the webinar. Ron, Tom, Tony, any last thoughts for the attendees?
I guess this is Ron. I say this is a really powerful program. I'd say you strongly consider participating in it and make sure you connect with your Raymond business advisor when you have questions on it, or even if you are going to apply for it, how do you make sure that you're using the funds in the most efficient way to keep your company surviving through this next 8-12 weeks and then thriving afterwards.
Great.
Yeah.
Well, thank you all for joining today. Oh, Tom, go ahead.
No, I was just going to say just a couple other points. If you're going through the process, and definitely reach out to a Raymond advisor if you want some assistance. Verifying your loan calculation or your debt forgiveness, or with the mechanics of the program. We're working. We'll be able to work with you on those calculations to help make sure you've got the right numbers in the right spots. And then, as kind of Ron said, this is just one piece of the puzzle. So having a 13-week cash flow, and then really also then expanding to make sure that you have a business model or a budgeting tool that you're looking at your break-even points, and where do you think you're going to be over the next 12 months? What can your business afford? Just because the SBA has loans available, it needs to make sense for your business. So we're trying to encourage people to look at the bigger picture and get the short-term money in, but be calculated with what the next steps are, and that starts with having good information about your business from a profitability and cash flow standpoint.
Great. Well, I thank you all for joining today. Thank you, Tom, Ron, and Tony for presenting. We really appreciate it. Just as a final reminder, the recording today and materials will be emailed directly to you today, as well as anyone who registered but could not attend. Additionally, please continue to visit raymond.com to view resources. We continue to stay on top of all of these hot topics, and we look forward to a webinar again soon. Thank you all.